But moving on the earnings front of HDFC Life also, which is expected to come out with its Q3 numbers. Overall, if you see in terms of the annual premium equivalent, that is expected to grow around 16%. Let me get in Harsh to get us more. Harsh, in terms of the expectation, what is on the cards? Because ahead of numbers, the stock is down a little over 2%.
When you're looking at HDFC Life, something like a mid-teens kind of growth expected where APE is concerned, which is annualized premium equivalent, which is equivalent to the top line of the company. You're expecting that number, which is APE in particular, to come around the 3,700 crore mark, which is around a 16% growth YOY. When you're looking at value of new business, which is equivalent to the profitability made on this new business, which HDFC Life will do in this quarter, the profitability will grow mid-single digit. What this means is that margins are getting squeezed. But when you're looking at it sequentially, margins are expected to remain flat at 24.3%. In Q1, HDFC Life has guided that they will attempt to maintain margins. They are happy to leave growth aside and maintain margins. Would be curious to know whether that commentary spills over into this quarter as well, that they are focusing in on the fact that they are not willing to dilute margins. How the product mix evolves is a large function of the margin number as well. So VNB margins expected at 24.3% this quarter as well, just like last quarter. Broadly, you're expecting a steady set from HDFC Life. The key surprise will definitely be the margin number if that were to get better. If that were to get better, I believe that's a big positive.
The margin number is something that we will be watching out for, and if that gets better, as Harsh is mentioning, it will be positive. But apart from that, you have a CEAT as well as LTTS, which is Mindtree, that will be L&T Technologies, I beg your pardon, that will be reporting numbers. CEAT, if you go to see, the revenues are expected to come in at around 3,347 odd crores. Margins are seen at 9.7%, and a profit number expected is around 102 odd crores. The stock is seeing some positivity today. And if you talk about L&T Technologies, margins are seen at around 15.75%. In terms of profit, a number of 373 odd crores is what we are expecting. Samir, coming to you, CEAT, L&T Technologies and HDFC Life, what is your view and expectation ahead of numbers? What would you advise investors to do?
So let's talk one at a time. Let's start with HDFC Life first. So yes, we believe that the insurance business is still at a very early stages in India, and the opportunity and the growth opportunity for all of them, especially the private side, is very strong. If you look at it, India is still very underpenetrated when it comes to really having term plans. People focus more on the fact of traditional policies where we get some amount of return or ULIPs, because everybody is looking at insurance as an investment rather than a risk aversion kind of product. Now, as the youth comes up and the youth is understanding the purpose of insurance, I believe that opportunity will keep growing, and the term policies will continue to have a great amount of traction, and that will lead to growth in the business. Now, where the problem lies for HDFC Life is they have always been a little slow in delivering the growth, which we are hoping will start turning around. They're talking of a 16% growth in the current quarter is what the expectation. If they're able to deliver that, I think that will be looked at positively. The positioning of the stock, you see, if you look at the stock, it's come off from almost, it had gone up to closer to 740 or something, and it's come off closer to 580 or right now. So we are seeing a decent correction. So any positive results, that positive traction or positive news that comes, like your person said, that if we see a slight margin uptake also, I think that could be looked at positively. We have a positive view on HDFC Life from a longer term perspective and recommend a buy for it. CEAT, the tire industry, we believe, is continuing to grow. And one of the best advantages of having a company like a CEAT or any tire company in your portfolio is the fact that any sort of vehicle sales growth that happens, whether it be electric engines, ICE engines, CNG engines, I mean, across the board, whatever it is, the tire industry stands to benefit, because at the end of the day, none of these, we've said this 100 times, none of these automobiles can run without the tires at the way they're planned right now. Now, if you look at specifically CEAT is trading at about 22 times trailing earnings and probably 20 times 1 year forward. This year's numbers are not expected to be growing that significantly. from the fact of view that we are seeing a slight bit of slowdown in the auto sector, but we believe as that recovery happens, companies like CEAT will continue to do well. Secondly, the secondary market share keeps growing, and the secondary market by itself, the pie is getting bigger. So if CEAT is able to maintain it to grow its market share marginally, we believe that could lead to a good amount of profitable growth. So CEAT is also a buy that we have from a 2-year perspective. We think a price of maybe 3,800 15 months down the line is quite possible.